Welcome to Retire Smart Maryland. My name is Cynthia and Prashant, and I'm joined today by Prashant 𝗧𝗜𝗦𝗦𝗦 of Elite Income Advisors. We're going to start this first segment off talking about something very important, the elephant in the room. We're talking about taxes. Wow. Prashant, how are you today?
I'm doing great. It's nice to see you.
It's so nice to see you. And I'm really, I don't want to say happy about talking about taxes, but I know we have to talk a little bit about it because obviously so many questions right now surrounding taxes. What's going to happen in the future? Should tax planning be starting right now with your retirement plan? So overall, I just want to ask you, Prashant, thoughts on taxes. Where are they now? Where are they going?
How much time do you have today?
I know, right? We better do a 90-minute show.
I know. So look, a lot to get to when it comes to tax planning. There's something out there that we refer to called the lump sum illusion, right? Lump sum illusion is you did a great job saving money. You put away money for decades through the ups and the downs of the market into your pre-tax retirement accounts because that's what you were advised to do. Put money in the 401k, get your employer match, accumulate and defer all those taxes, and now you have $1 million or $500,000 or $2 million saved. But that lump sum that you have is actually an illusion because when you get to retirement, now you start withdrawing that money, guess what happens?
Taxes.
You have to pay tax on every last cent of that pre-tax money, both federal and state, if you're living in a state that taxes your income. And so that's what we call the lump sum illusion. $1 million question is how do we deal with it, right? We know that we stashed away all this money and we gotta be able to deal with that one day because look, when you go to create that income in retirement, you're taking that paycheck out, and now that $1 million is not actually $1 million. You might end up paying 25 or 30% in taxes on it. It's really only $700,000. And so with that being said, I think you have to reframe your mindset. Is $700,000 net after tax actually enough for you to have the retirement that you deserve? And so that's what I call the lump sum illusion. There's a lot to get into with regards to taxes, but I think that's a great place to start is we have to kind of train our minds to think about our money differently. And it's because Uncle Sam has their hands in our pocket.
Well, speaking of Uncle Sam, let me ask you a question. The difference between tax preparation and tax planning, can you explain that a little bit in detail in case viewers are thinking, well, I have my accountant that I see, he's going to do my taxes, so that's my plan. Let's break it down even further.
Huge distinction between tax prep and tax planning, okay? One is looking backwards and one is looking forwards. Tax preparation is just looking at the previous year's worth of income and dividends and deductions that you can claim and reporting that to the IRS so that you can properly file your taxes and be in compliance. Tax planning is totally different. Tax planning looks forward. Think about 5 years, 7, 10, 15 years from now. Think about when you're gone and now the estate that you've accumulated gets transferred to the ones that you care the most about. Tax planning utilizes strategies that are proactive to make sure that you pay the least amount of taxes possible, both while you're retired and even after you're gone. One is looking backwards, one is looking forwards. Now, Cynthia, question we get all the time is, how do I know that I'm ready for tax planning? I think there's a misconception out there that working with a CPA and doing real tax planning is only for folks that have a lot of money. And it couldn't be further from the truth. Okay. I don't care if you have $250,000, $1 million. We see people that have 10 or 15 or $20 million. Every single person needs to have that tax planning discussion because look, taxes are always going to be there, regardless of what income bracket you fall in, regardless of the value of your estate. Taxes are always going to be there, and it's something that we have to be very cognizant of.
Well, something else we should be cognizant of. You always talk about the tax time bomb. Prashant, what is the tax time bomb?
So that goes back to the lump sum illusion a little bit. The tax time bomb is ticking inside of your pre-tax retirement accounts. My partner, Nick Interbickler, and myself, we shot a video on this. I think we have that clip. Let's go to that clip on the tax time bomb.
Okay.
you've probably been saving money into things like your 401k, your IRA, your thrift savings plan over the course of your entire career. But are you aware of the ticking tax time bomb? Nick, tell us a little bit more about that.
Yeah, if you have accumulated a lot of money in your retirement plans through your employer, it's like your pension today. There's a big thing that will happen to you in the future. And there's a lot of confusion about this, and we want to talk about it a lot, is something called a required minimum distribution. If you're 60 years old and you have $1 million in your retirement account and you're going to work another 5, 6, 7 years, by the time, with growth in the market, by the time you reach that RMD age, required minimum distribution, 73, 75, whatever it might be, you're going to have to take a large taxable distribution from that account and pay taxes on it.
And that kind of creates a domino effect, doesn't it? I mean, when you take that money out, you got to pay it as ordinary income. So you pay federal and state tax on every single last cent that you take out. And what that does is it creates this domino effect, right? It has Social Security implications. Maybe the amount of your Social Security that gets taxed goes up. What about Medicare?
Medicare, yeah.
Medicare premiums are linked to your income, right?
We talk about income a lot.
Yep.
And everybody that comes in doesn't realize this time bomb that's in their retirement plan. And you may not need this money, but the government is going to force you to take a distribution.
And then what happens when you pass away?
Yeah.
You end up paying the tax on all that money at that point in time.
The government doesn't allow you to forgive those taxes. Yeah.
So are you aware of the time bomb that your portfolio has with regards to taxes? Make sure you get that under control.
Wow, Prashant, that is an amazing video. It helps to really unpack the tax time bomb and how do we avoid it. Wow.
It's a domino effect, Cynthia.
Yeah.
One decision as simple as putting money in your 401k, which you were told is the right thing for you to do,
absolutely
creates this incredible domino effect that has really a lasting impact on your tax rate, tax brackets, taxes paid at the time of death, your Medicare premium. You're starting to see how all areas of the retirement planning process, they all intersect. 20 years ago, they didn't intersect quite as much because you just had a pension, you had some Social Security. You didn't have to worry that much about the personal savings aspect of it. In this day and age, it is more important than ever to create a plan that is coordinated, comprehensive, and customized. Those are the 3 C's of retirement planning, and you have to make sure that you have them in check.
Sure, that makes perfect sense. So when you're looking at someone's overall picture for tax planning, Prashant, do you talk about things such as the Roth conversion?
Yeah, so there's actually this really neat analysis that we do. It's actually a side-by-side analysis. I'll give you an example. Let's say that you have $1 million saved for retirement, and it's all in pre-tax retirement accounts. We have a projection tool that can show you the total tax liability on that $1 million. So we're talking about the total tax liability when you account for things like the potential of rising taxes, required minimum distributions, what happens if you reinvest the required minimum distributions that Nick was talking about in the video, and then what happens at the time of death, how much tax will your heirs pay? And we can compare that with the scenario of what if you were to convert all of that money into a tax-free status? And when you look at the side-by-side comparison, the differential in the numbers is mind-blowing.
Wow.
We're talking about potentially paying hundreds of thousands of dollars more in income tax over the course of your lifetime by leaving your money in a tax-deferred status. And it's such an interesting thing because what I'm talking about now goes against everything that we were taught when we were accumulating.
It does.
In my opinion, putting money in pre-tax retirement accounts is no longer the best way to save for retirement. We have to look at what I call tax preferred and then tax-free vehicles to allow us to have the most tax preferential retirement that, quite frankly, we deserve after decades of hard work. Folks, if you have not had that tax analysis done, pick up the phone, call this phone number. It's 833-308-5200. When you call that number, have your calendar ready to go. When you have your calendar out, our team of operators will schedule you for a complimentary visit with our team of advisors. When you come in to visit with us, you can claim your own free tax report, which will go through things like Roth conversion. This is what we call the Retire Smart road mapping process. Not only will we talk about taxes, but we'll map out your income in a very simple, easy to understand way. You'll be able to look at one sheet of paper and have a great understanding of what your income is projected to look like each and every year for the rest of your life, taking into account things like rising inflation and even the threat of higher taxes. It starts with that phone call, 833-308-5200. It is absolutely complimentary. At any point in the process, if you feel like my team is not a good fit for you, you can walk away, no questions asked. Pick up the phone, give us a call.
Prashant, thank you so much. Again, to the viewers at home, this could be the most important phone call that you make. You're talking about your financial plan for your financial future, for your retirement years. Remember, you deserve this. You've worked your entire life to get to the retirement years. Wouldn't you want to know today if you're not on the right path for retirement? What Prashant is offering you today is a completely complimentary review. Let him get to know you and vice versa to see if you need to have the Retire Smart roadmap drawn for your retirement plan. Again, the number is 833-308-5200. If you have your smartphone handy, go ahead, grab it. Click on that QR code at the bottom corner of your screen. That will take you right to Elite Income Advisors landing page. We're going to take a very short commercial break. You may have heard something about the Secure Act 2.0. I want to talk to Prashant about exactly what that is. What changes should we be aware of? Stay tuned.
My philosophy is that losses hurt more than gains help. And it's all about creating a strong foundation. And in my opinion, that foundation is the foundation of having income that you can always depend on.
Most of the financial advisors focus on the accumulation phase because that's the one who brings most of the revenue to the firm.
I believe that the strongest retirement plans are created with creating a solid foundation for where your income is going to come from, and then building the rest of the plan in as low risk of a way as possible.
That's why it makes us slightly different than other firms, that we focus on the distribution side, not the accumulation side. Distribution side is the most important part of the time because you're retired and you want to make sure you have all the income coming in.
While you're working, you're always just juggling money coming in and money going out. And when you retire, that doesn't really change. It's still very much about income coming in and expenses going out. What changes is where that income is actually going to come from. What we focus on is making sure that we can walk somebody from A to Z through their income, their investments, their insurance, their estate planning, their tax planning, and really wrap it all together in an easy to understand way that truly is focused on educating.
Welcome back to Retire Smart Maryland. My name is Cynthia and Prashant, joined today by Prashant 𝗧𝗜𝗑𝗦 of Elite Income Advisors, and we're talking about taxes, tax planning, but in this segment, the Secure Act 2.0. So Prashant, I have to ask you, people may have gotten comfortable with the Secure Act, right? But now we have some changes. We have the Secure Act 2.0. What's new? What's different? What should people be thinking
Just
about?
when people were getting comfortable with it, they passed this $1.7 trillion with a T omnibus bill spending package, and buried in that bill was Secure Act 2.0. So a couple highlights here. We know that required minimum distributions used to be at 70 and a half, went to 72 years old with the original Secure Act. That has now been raised to 73 years old. So they pushed that out to 73. For some folks who are a little bit younger, their RMD age will actually be 75 years old in the future. So in my opinion, that could be a good thing. Yeah. Okay. On the surface, it seems like it's a good thing until we realize that RMDs are taxable. They're all fully taxable. And by kicking that age out, the government is incentivizing us to not touch that money for another year or two, depending on your age. But the problem is, most people think taxes are going to be higher in the future.
You're exactly right.
And so it's totally backwards, in my opinion, right? So that's a big highlight. Now, one of the good things that happened was that they reduced the actual penalty for making a mistake with your RMD. It used to be a penalty of 50%.
Wow, 50%.
Correct. So if I had an RMD of $40,000 and I did not take that money out, I'd be forced to take the $40,000 out, but then I'd have to take an additional $20,000 as a 50% penalty and pay tax on all of that additional income.
Wow.
So the good thing is that has changed with Secure Act 2.0. That penalty has been reduced from 50% down to 25%. Still pretty high penalty, by the way.
Absolutely.
So you absolutely do not want to make mistakes when it comes to your required minimum distribution. But the good news is if you do have a little bit of a moment of weakness and forget to do the RMD, the penalties are a little bit less steep.
Okay. Okay, so that's good.
That is a good one. And then going back to the original Secure Act, I think one thing we have to talk about is we have so many people that come in to visit with us talking about legacy.
Yes.
I think legacy is so important in the planning process for this reason, Cynthia. Pensions have gone away. And so when we start to think about our children and what their retirement will look like, they're not going to have the ability to have an income of $50,000, $60,000, $70,000 a year from a pension.
Yeah,
what about Social Security insolvency? Okay, right. Back in 1940, there were 159 taxpayers, covered workers, for every one Social Security recipient.
Wow.
You know what that number is today?
No.
At the end of 2023, it was 2.7. 159 versus 2.7.
Wow.
And that speaks to the insolvency issue that Social Security faces.
Yeah.
And how this all ties into legacy is that our children, your grandkids, are not going to have the pensions that you have. And so now what they're going to have to do is save more of their own money to recreate that guaranteed paycheck in retirement. And oftentimes they're going to be forced to save $1 million, $2 million, $3 million, $4 million, $5 million in a lot of cases to create the income that you have today.
Wow.
If you could play some small part in helping them accumulate that $2, $3, $4, $5 million, wouldn't you want to know about it ahead of time?
Of course.
What if you could do that in a tax-free way to them?
Yeah.
Okay, we don't want Uncle Sam touching and influencing our legacy. If you haven't thought about legacy planning from that perspective and what it will truly mean to your kids and your grandkids, I'd say you have to start that process now. And most importantly, you have to work with the right specialist in that planning process, because if you do it incorrectly, it could actually be a huge disaster.
Yes.
And you don't want to leave your kids and your heirs with a bigger burden when you're gone.
Well, that's what I'm thinking, Prashant, because a lot of times when people are inheriting money from people that passed away, they're in their prime working years,
That's
right? And so if you have all of this income suddenly coming in, couldn't that increase your tax bracket if you're not planning accordingly?
Exactly, because this goes back to Secure Act, and the old rule used to be that if you left your retirement assets, your pre-tax retirement assets, to your non-spouse beneficiary, previously, they were allowed to actually stretch the tax hit out over the course of their entire lifetime. So in the example you just gave, if I inherit money and let's say I'm 45 years old and I end up living to be 90 years old, I could potentially spread that tax hit out over a 45-year period of time. Pretty sweet,
That
right?
is, that is.
And then the government determined it was too sweet, and so they got rid of it. And the new rule is 10 years. That's it. So now I inherit $1 million at 45 years old, and I have to spread that tax hit out over no more than a 10-year period of time. Wow. Well, I'm not planning to retire by the time I'm 55, right?
Exactly.
Most people are not going to plan to retire at that stage of their life, which means they're going to have to tap into that inheritance in addition to their income, which could increase their tax bracket, have really a tax domino effect that you have to deal with. It's a huge, huge problem that not a lot of advisors are talking about. And this is where I think advisors have fallen tremendously short in helping their clients. I think advisors have failed their clients in legacy planning.
Absolutely. Well, Prashant, I know how busy you are, but I also know that you've saved some time aside for new clients that are viewers of this show today. Let's talk a little bit about what that offer is to those folks before we take a commercial break.
Look, when you dial this phone number, 833-308-5200, you are not agreeing to become a client. Okay, you're not agreeing to do business with us. You're not agreeing to have us manage your money. What you are doing, though, is you're getting exactly what you need to retire smart. And that is a Retire Smart roadmap. It's an income plan, mapping out your income. It's a conversation about taxes. Is the threat of higher taxes going to have a negative impact on your ability to create your net paycheck in retirement? What about your legacy plan? Have you thought about how the money you leave your kids and grandkids will influence their ability to retire and what taxes they will pay on that inheritance? If you haven't talked about this before, come speak with us. You need this in order to retire comfortably, in my opinion. You need a plan. When you come in to visit, it's totally complimentary. At any point in the process, if you feel that we're not a good fit for you, you're totally okay to let us know, and we will go our separate ways. No hard feelings. But for a lot of our viewership, you come into the office, we put that plan together, and we find that we're a great fit for what it is that you want to accomplish. It all starts with that phone call. Pick up the phone, have your calendar in front of you, schedule that no cost, no obligation visit with our team of retirement specialists at Elite Income Advisors.
Prashant, thank you so much. To our viewers at home, that number to call is 833-308-5200. And you deserve to have the Retire Smart roadmap drawn for you. This is your own personal journey and path to retirement. Make sure it's the correct one. Once again, 833-308-5200. We're going to take a very short commercial break. I have so much more with Prashant when we return.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to Retire Smart Maryland. My name is Cynthia and Prashant, joined today by Prashant 𝗧𝗜𝗘𝗦𝗦 of Elite Income Advisors, and we are talking all about your retirement planning. Prashant, we have some common scenarios that are found on the internet. So if you don't mind, could I toss out a couple to you right now?
Please, let's do it.
This first one is very interesting. It says, I'm 64 and I'm getting ready to retire in 1 year. I owe approximately $165,000 on my house with no other debt. I have close to $850,000 in retirement savings. $2,200 a month is from a pension, approximately $2,300 a month from Social Security benefits, and $300 a month from my ex-wife's pension. I also drive Uber for approximately $1,500 a month. Does it make sense for me to pay off my house at the time I retire?
Great question, great scenario to go through. Very common, okay? Because look, I think debt acts as a bit of an anchor when you get to retirement. It drags you down, and the feeling of having to owe somebody something is kind of an overwhelming thing to go through when you're retired. But we have to be really smart about this, okay? It comes down to the tax side of this, in my opinion. Okay, you did a great job saving in this example, $850,000.
Absolutely.
Still owe a little bit on the mortgage. When we go to access money from our retirement accounts to pay off the mortgage, how much did they say that they owed on the mortgage there?
$165,000.
$165,000. In order to withdraw enough money to pay off the $165,000, we probably need close to $200,000 as a withdrawal, if not more than that, just to then pay the taxes to pay off $165,000. So here's the way I look at it. This is a classic case of calculating whether or not you have a retirement income gap, okay? Having debt in retirement is not the end of the world, okay?
Okay.
It only becomes an issue in the absence of an income to service the debt, okay? So what if you were able to take some part of that $850,000 and put it into a vehicle that gave you enough income to actually make your mortgage payment every month?
Okay.
would that be better than paying a ton of taxes up
Absolutely.
front, but yet you still have what you need to service the debt?
Yeah.
These are the types of strategies that we talk with our clients about every single day. Just remember, debt becomes an issue in the absence of income.
Perfect. Thank you, Prashant. This next scenario, I have a pension that kicks in at age 57, and I'm 55 now. I also have a 457 deferred compensation plan that I contribute to. My question is, would it be a good idea to contribute to a Roth IRA as well? Having tax-free money later on sounds like a good idea. So contribute. Let's go with
Yes.
contribute, shall we?
Yep. And look, we see this a lot with state of Maryland employees who have access to the 457B and a pension. Look, income tax-free, I always joke, income tax-free are my 3 favorite words in the industry. Okay,
Yes.
look, taxes are going up. It's a scary thing to have to potentially deal with in the future. I want as much stuff that is income tax-free as I can get. Now look, there is no cookie cutter advice. It's hard to answer a question like that without knowing a little bit more. As a fiduciary,
Sure.
I'm obligated to operate with the fiduciary standard, looking out for clients' best interests. So hard to give a specific answer to that question, but one thing I will say is creating more streams of tax-free income in retirement, in my book, is always a good thing. Okay. Now you have to examine what the cost of that is, meaning you might pay more in taxes today in exchange for paying no taxes in the future. You're going to have to evaluate whether or not that is the right thing to do.
Okay.
I love these scenarios because I know that these are scenarios that people are dealing with in real life today. And I know that because our TV viewership comes into the office, they sit down with our team, and they tell us exactly what they're concerned about. Taxes are a concern, the market is a concern, rising costs of inflation and healthcare are a huge, huge concern in retirement. I know that you have these concerns. We're going to help you work through each and every one of them. All you have to do is do your part. Pick up the phone, give us a call, 833-308-5200. My mom always told me you don't have to have the answers, but you need to know who to ask. We're going to help you through that process by creating the Retire Smart Roadmap for you. Complimentary, no obligation. Pick up the phone, scan the QR code, come on in and visit.
Prashant, thank you so very much. To our viewers at home, thank you for spending time with us today on Retire Smart Maryland. Any questions for Prashant? The number 833-308-5200. Be safe and be happy, be blessed. We'll see you back here 1 week from today. Take care now.